Partnered by Times Influence.
Hello and welcome to Voyage Navigate 2018, a knowledge-sharing platform from the house of Aditya Birla Sun Life Mutual Fund. It's been 5 years since the flagship event first set sail, and now, in the presence of over 2,000 guests, the 5th edition has ensured that both investors and distributors are well poised to make the best of opportunities that India has to offer. First up on today's episode, Ramesh Nair of Jones Lang LaSalle India shares his expertise on trends that are impacting India's real estate sector. Let's take a look.
There have been lots of policy changes impacting real estate. The first big one was the Real Estate Regulatory Act, which was formulated back in 2016, but finally it became an act in 2017 mid. This will definitely lead to timely project completion, which was a big worry, because of which the real estate sector lost a lot of, there was huge amount of trust deficit in the sector. We believe RERA implementation would definitely help the overall market. The biggest challenge of the real estate sector was accountability and transparency. That again is improving with RERA. We definitely expect a lot of consolidation in the industry. There are close to 12,000 real estate developers in the country. We are not going to be such a hugely large, diverse industry. It will again consolidate. Corporate governance, which was unheard of in the real estate sector, is again changing significantly thanks to RERA. Demonetization happened in the last quarter of 2016. What was the impact of demonetization? There was a time when a lot of stock market gurus, equity analysts said real estate market in the country will correct 30 to 50%. Our research shows the worst affected markets had only corrected around 10%. Most markets had corrected anywhere between 3 to 7% across the country. There was definite reduction in launches and sales. Last year we saw 2016 versus 17. The amount of launches was close to 20% drop in launches and close to 35% drop in sales. This is the post demonetization 16 versus 17. The most impacted sector, because the cash went out, was the agricultural land aggregation, plot promotion, and secondary residential sales. These were the three most impacted sectors. The market which was most affected, no prices for guessing, was the Delhi NCR market, while the market which was least affected, most transparent and the most white-collar market driven by end users, Bangalore was the least affected. What are the key takeaways for real estate developers from all the changes happening, the regulatory changes happening? They need to start focusing more on corporate governance and compliance, which is something we are already seeing. They need to create a brand which is driven by quality and project delivery. And today what we are seeing across the market is lots of strategic tie-up between peers. Previously it was tough to hear developers talk about partnerships. Today across the country we could hear a lot more developers partnering with each other. Affordable housing is a really big opportunity. CLSA recently spoke about the overall demand for affordable housing in the country, and they put the number at 10 million units per annum. So we're talking 1 crore housing units required per annum in the country, out of which 3.5 million was coming because of population growth, 2.5 million coming out of nuclearizations, families becoming smaller, and another 4 million coming because of aspirational, which is families wanting to move from a smaller house to a larger house. So big numbers, 10 million units. Out of this 10 million units, 30 million units would be urban housing demand, and 20 million units would be rural housing demand. But if affordable housing needs to become a reality, the government has spoken about housing for all by 2022. Obviously that won't happen because this huge amount of supply to people. But even if we can do half of that, the country would go through a phenomenal rise in real estate investments. Obviously, a lot more FDI would have to come into the country if that has to happen. The government unlocks land potential, creates fast-track approvals, reduces development cost, incentivizes rental ownership, creates more financing schemes and provides loans for land, we could see a huge amount of demand uptake for affordable housing. In a nutshell, we believe real estate is becoming a lot more transparent. The sector will become a lot more accountable. There will be a lot more corporate governance in this sector. I personally believe we couldn't have seen a bad year as bad as last year, where all the whammies, like 5 to 6 different whammies which hit the real estate sector, and things can't get worse than that. And I would end the speech by saying this is a asset class where you won't see Black Fridays where your wealth could get eroded by 30%. Thank you.
Should one invest into smart cities or urban cities for gains?
Good question. I think smart city investment should be based on where the job creation is actually happening. When you're looking at smart cities, look at office market as an indicator, industrial investment as an indicator. You can only invest in places where there is job creation happening. It's easy to announce as a city and put a few cameras and a few smart things and sensors and call it a smart city, but real job creation needs to happen, and that's happening in very less cities currently, according to me.
Fantastic. The second question says, what is the rule according to RERA on GST? Is it leviable on the investor or borne by the builder or developer?
So GST is payable by the developer. Obviously, the developer is going to put that in the cost. Our current findings clearly tell us that GST, if you look at the overall country, there is limited impact. We would say pre-GST and post-GST, the rates. Today the rates is 12% for non-affordable category and 8% for affordable category is more or less same. So if you look at the previous regime of VAT plus service tax plus non-availability of input credit was coming to around the 12% mark, and today GST is also a 12% mark. So what the government has told is 18% plus 33% reduction in terms of land cost in that. So it's more or less not much of impact in terms of GST.
Thank you so much. Ladies and gentlemen, Mr. Ramesh Nair.
Moving ahead, Pawan Agarwal of CRISIL shares his thoughts on the changing trends in India's infrastructure sector.
So if you look at Indian infrastructure, clearly all of you are aware that we are at a stage where we need a very significant upgradation in the infrastructure requirements, be it roads, be it ports, power, etc. How is this that this infrastructure is going to be funded? A 50 lakh crore over 5 years is a very large sum. Clearly banks today are a little more cautious and wary about investment or lending to infrastructure. And therefore, one of the key areas that we need to watch for as investors to the sector is how is the bond market able to develop and how is it able to contribute towards funding the infrastructure. I think globally, a majority of the infrastructure is funded by bond market. We believe that there are enough drivers which have led to the growth in the bond market and what will continue to have bond market fund infrastructure. Most of the funding for infrastructure through bond market has today been indirect, which means that there are large NBFCs which are owned by government. There are large NBFCs or players or banks they will raise funding through the bond market, let's say a Power Finance Corporation, let's say a Power Grid which will borrow directly. There will be some of the infrastructure debt funds, they will borrow for refinancing. But direct access of infrastructure projects to the bond market is where there is a gap. I think we need to build institutional capacity to be able to do that. But beyond institutional capacity on funding, I think equally important that the way the business is done, the way the projects are developed, our focus changes and moves towards greater focus on contracts defined upfront, much more tighter covenants which are defined again upfront, which will give confidence to bond market investors to invest in infrastructure projects which by nature have a longer gestation, which will require upfront investment but will throw up cash only over a longer period of time. As an investor, what does it mean to be, let's say, looking at infrastructure sector where it is today? I think infrastructure sector by the very nature of it being long term requires predictability in policies. I think we have seen in the past somewhere when policy changes have happened to the detriment of investors, the environment, investment environment kind of changes. But the predictability of policies is an important and critical measure, and we are seeing some of the segments where private sector participation has come back is a reflection of predictable policies. I think ecosystem in infrastructure today is clearly maturing. If we compare 2018 by, let's say, 2009 or 10, when a lot of infrastructure investment happened or was beginning to happen in roads and thermal power, what is one of the changes that we are seeing is today larger and specialized players are available who can provide funding, equity, debt, as well as post-completion churn, both on the debt side as well as equity side. The scale should still be higher, but certainly this is much more positive compared to what we have seen in the past. I think important to note that investment in infrastructure requires certain amount of patience. Infrastructure projects and developers are leveraged utilities. I think important for players to, or investors to keep a track of the balance sheet structure, keep a watch on credit ratings. It is very unlikely that equity investors will make money in a situation where lenders are taking haircuts in infrastructure assets. And I think clearly, while opportunities are large and strong, I think discipline on growth is an important element that will help you decide or choose which of the companies or opportunities to pursue and invest in a wiser manner. So with that, I end. Thanks a lot.
Infrastructure as a sector is seen as a direct proportional indicator of a country's growth. Given the commitment of the government on infra in the near future, what do you think the future holds for the coming decade?
No, clearly, I think for India's economic potential to succeed, I think investment in infrastructure is critical. It is important to ensure that our export competitiveness remains. If you look at last few years, a lack of infrastructure has actually led to a situation where our exports have grown by just about 1% in the last few, maybe 6 or 7 years. And unless we are able to figure out a solution for investment in infrastructure on a broader basis, I think the potential or ability to grow sustainably at 8% is going to be difficult. We are beginning to already see a lot of activity happening, a lot of repair, a lot of policy correction, stability, predictability coming into the sector, but a lot more needs to be done.
Are you bullish or bearish on infra for the next 6 months?
If you ask me from a credit perspective, there are enough areas to be worried about, but if you look at even within that, are there opportunities which are there? I think as I spoke about, there are enough opportunities. So if you are selective, if you have an horizon which is longer, and to that extent, I will certainly say that if you are wanting to invest in infrastructure, the horizon has to be at least 5 to 6 years rather than 6 months. And if you keep that horizon and you keep the discipline of looking at some of the sectors where opportunities are there and picking up players who have grown discipline in a disciplined manner, I certainly am optimistic on the sector.
Fantastic. Thank you so much. Ladies and gentlemen, round of applause for Mr. Pawan Agarwal.
You're watching Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018 powered by ET Now. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back to Voyage Navigate 2018. Now moving ahead, ET Now's Aisha Faridi puts the spotlight on what drives India's booming real estate, infrastructure and BFSI sectors. Let's take a look at the highlights.
Today we're trying to analyze through the spyglass a sector analysis, and the gentlemen right here are are champions of the real estate, infrastructure, as well as the BFSI segment. And they're going to help us figure out whether or not the infrastructure as well as the realty sector, is it actually at the pinnacle of a turnaround? Jaspreet, if I could start with you firstly. Real estate, we all know, has been in a bad shape. And I'm not talking about how the stock performances have been in the last year. But what about things on ground? Do you really see those yellow weeds springing up, or are we still sailing in the deep sea?
In essence, what we see on the ground is there are two parts of real estate. Consolidation that's happening in the industry, how regulation is changing the industry for the better. We've also seen, to some extent, the taint in the industry is because of what's happened between, say, 2012 and 2017, where the supply that came in 2012-13 catered to a certain segment of the economy. At that time, investors were a big part of the real estate market, particularly in the north. A lot of the supply actually catered to that type of demand. That's one part of the market. There's another part of the market, which is the upcoming supply or the upcoming launches. We haven't seen much of it in 2017, but what is being launched is a smaller ticket, more affordable, targeting somebody who actually wants to live there. So we've seen this market, somewhat be recalibrated by developers. We've also seen that, to some extent, the ones that are left to create this new supply have pristine balance sheets. They're large institutional players, and to some extent they've had both a commercial as well as a residential side to their development business. The commercial side has helped out the residential business. So pretty much any balance sheet you look, a listed balance sheet of a developer today is in very good condition. So when we think of real estate, we're looking at what has happened over the past and the thousands of developers that we've talked about earlier. What is remaining now is maybe 200 of them, which are actually coming up with more relevant type of supply. So that's the type of difference there is in the past and the future. We're actually betting on the future, and that this upcoming supply will get absorbed. It's a cyclical industry. We are at a low ebb. We expect things to get much, much better from here.
Chanchal, that brings me to the next question, because there has been increased regulation because of RERA. Where are things as of now? I mean, has all the adjustment because of RERA settled down? Are developers now in a much easy space as they were when the reform was put in place?
Real estate in the past was about hoarding real estate and selling as the price increases. Developers were more focused on value than volume. Few structural reforms which has changed, RERA and affordable housing. Today, there are the entire real estate market is $100 billion. And think of it, none of the listed players are more than $1 billion in sales. DLF in the old age used to do 12 million square foot, but today 3 or 4 million square foot is what they are capped at. But I think with RERA, things will turn around. It has started to happen. It's a slow process. Developers will focus on capital allocation, return on capital employed, churn it faster and move ahead. So we think the number of organized players will benefit, and structurally this sector is going to change.
Vineet, you track the infrastructure sector very, very closely. Where are you finding opportunities? Because time and again that we cover business news, you only hear the NBCCs, NCCs and the road developers of the world getting orders after orders. But is that true for the entire sector?
Well, it is true that road developers are, mostly in limelight. But if you look at it, there's about 50 lakh crores worth of infra opportunity over the next 5 years. That's $750 billion, right? And out of that, if you look at, the areas which are actually doing well, which are like roads, railways, power transmission, urban infra, they would be somewhere around $400 to $500 billion. And most of the opportunity to us as investors lies in the whole value chain of infra, which is the contractors, which is the EPC companies, the equipment suppliers, which are the engineering companies, and the material suppliers, like cement, steel, etc. So one has to tap the whole value chain to take advantage of these opportunities, because the guy who actually owns the infra asset, may not provide that kind of growth opportunities, because the contractors move from one project to another, and they typically work on a portfolio of projects, so they are less riskier also that way. So that's where we are looking for opportunities, the guys who are involved in the whole value chain of the infra sector.
Chanchal, when it comes to pricing, I mean, I know a low barrel would be different than Kandivali and so on and so forth. NCR would be different than maybe South Delhi, etc. And every city has its own dynamics. But generally, per se, the view in the market is that there is oversupply, there is a demand-supply mismatch, like Jaspreet was earlier mentioning. Are we anywhere close to a bottom when it comes to prices, or do you think they're going to consolidate for some more time around these levels?
So if you look at last 4 years, real estate prices have gone nowhere, right? And the reason there was a change in regulation 2 years back where the loss from house property, which salaried income used to get, that regulation had changed, right? Previously, salaried people or people with salary income used to buy housing, used to invest in housing as an asset class to get the benefit of loss from house property. So few change in regulations which have happened in last 2 through 3 years has increased the supply of real estate in the market, and the investor and the speculator who were sitting and investing in the market and getting a sweet return, they are no longer available in the market. So that's the reason we have seen an increase in the supply in terms of the real estate market. Last 2 years has been very bad. The supply has reduced, whereas demand has improved. If you see, the consumer sentiment is better now. GDP growth is better. So people are looking to buy real estate. So I think we are somewhere in the place where the consolidation in the sector is happening. Prices has bottomed out. If someone wants to buy a house to stay, this is the best time in the next 6 to 12 months to buy a house. But as an investment class, I don't think real estate is suited as an investment class. Your financial asset is far, far, far superior asset class to invest in.
Vineet, irrespective of that, do you think infrastructure funds are a good investment? And why then in your own fund you have bank stocks?
Infra funds, to the extent there's an opportunity available to be profited from, they become good investments. We want to, invest across the value chain. And the key input to any infra asset is, other than, materials and equipment, etc., is capital. And banks are the one, currently we're doing the major job of, intermediation in terms of financial intermediation and collect the most amount of capital from the general public. So banks become an essential part of, that value chain. And that's why we have some exposure to banks within our funds. But mostly if you look at it versus any other fund, I mean, they would form a smaller part. The larger part would obviously be, other guys like, again, EPC, equipment supplies, or material supplies like cement, etc.
We always have a Hindi filmy idea of gundas going to someone's house and recovering money. How do fund managers like you recover your money?
So actually, the real estate financing market is actually quite evolved. In that,
no gundas?
No gundas. No, it's involved in that, and this has happened over the last 10 years. The most important thing, so first of all, people have this impression that like other manufacturing investments, there's a guy sitting at a desk looking at a screen and making an investment. And that's not how it operates. There's an entire team required to make one real estate loan. The premise, the most important thing in real estate lending is something called an escrow account, where basically any sale, a residential unit which is sold to X, Y, or Z or whoever, the check from that comes into the escrow account. There is somebody who sits and monitors that escrow account, and every time the developer wants to make an expense, he signs the account. His signature is required, and he sits, he's on our payroll. He releases money to the developer to construct the building. In addition to that, there's another guy who goes to the site every month to ensure when the developer withdrew 5 lakhs, to ensure that 5 lakhs actually went in to the project. He looks at receipts, he makes sure. So it's very difficult for a developer in this financing architecture to actually siphon money. It has happened, I know, but if you look at the overall performance of real estate finance, and this is from 2012 to today, and you've seen what's happened in other sectors, real estate has not seen NPAs at all. It's not seen NPAs in banks or NBFCs. Managing the escrow and how you manage it, it's a critical function in the entire game. So it makes gundas redundant because to some extent you're controlling the cash.
But thank you so much, Aisha. Thank you, Vineet, Jaspreet, and Chanchal for that. Thank you so much. Ladies and gentlemen, round of applause for them.
Well, that's all that we have on this episode of Aditya Birla Sun Life Mutual Fund presents Voyage Navigate 2018. But do tune in next week for the final episode of the series, where we'll hear from policymakers and thought leaders. Thank you very much for watching.
Partnered by Times Influence.